Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name's Corey Kramer and today we're going to be analyzing Leggett and Platt stock, ticker LEG. This one came in by request from several different people down in the comment section of some of my other videos, so I got it on the list of on the whiteboard behind me, and now I'm making a video. If you have a request, just drop it down in the comment section. I'll get the ticker on the whiteboard. There are more back there than just the ones we see now. So I have a few to get through still, but eventually I will make a video if you request one. If it's a stock that's in the S&P 500, I post those on YouTube for free. Every now and then I'll post an additional one that might not be in the S&P 500. I actually didn't check Leggett and Platt. I think it is. But I'm going to post it here on YouTube because it's a pretty interesting one to look at and think about and discuss. As always, this is not individual investing advice. This is just how I analyze stocks. If I do post videos that are not of stocks that aren't in the S&P 500, I post those on Patreon and also in my full service over on Seeking Alpha. Patreon's $5 a month, and if you join there, you can get a big discount if you ever decide to join the full Cyclical Investors Club service, and those links will be down in the description. There's also a link to, you'll see me using Fast Graphs here, which is up on the screen. There's also a 25% off affiliate link down there for Fast Graphs. It's going to come in pretty handy, I think, for this analysis in particular, because historical cyclicality plays a kind of a big role. I do track this one in my dividend sheet because I think it's a dividend king. But I don't currently track it, or at least I wasn't that I saw anyway, in my normal sheet. And I'm not sure why, probably because it kind of straddles a line of a couple different things here. So let's first try to properly categorize this as cyclical or not, or what's going on. If we look at the drawdown back during the Great Recession, so my basic standard is, if earnings fall more than 50% and then eventually recover, that's a deep cyclical business, basically. So when I go back, I can look at these earnings. They peaked out, I'm looking at just the annual ones, at $1.56 per share. They bottomed at 86 cents per share. So, and you can see now if you add these up, it will be more than 50%. But that's because they're cumulative from year to year. It's 27% lower than 120. It's not 27% lower than 150. So, but if you look, you can tell that, if you double 86, you get 172 or something like that. So that's more than $1.56. So it didn't quite fall actually 50%. It probably fell 45%, give or take. So technically, it's not necessarily a deep cyclical if we just use a strict kind of 50% drawdown cutoff. But I would probably, what that means for me is I really want to pick the right type of technique and analysis to analyze the stock. And when you have really deep earnings drawdowns, the earnings become not very predictive of the future stock price, right? So it probably had similar, if we just look at here, the PE was 15. Here, the PE actually was 16. It was more expensive, but it was significantly lower. But the returns, if you bought down here, would have been much better than if you had bought up here. So that's the problem when earnings are falling. They tend to make things look worse if you assume that they'll keep falling like that for a while. And it can throw off a normal valuation. So what I do in that case is there's a couple different things we can do, and I'm going to show you both of them. One of them is, because this is a dividend king, you can use a dividend analysis. So they have very stable dividends for the most part during this entire period. It looks like they raised them a lot this year, which is interesting going into the recession. But you can use the dividends sometimes if you think they're sustainable, which is going to become a question here, to gauge the valuation. So I have a way we can do that. So that's one way to look at it, and I'll look at it that way. We can also use more of a deep cyclical style of analysis to look at the historical price patterns, which I think probably would be useful. It would have been more useful up here when this started going down for people to know what the downside was. But it can, when you put all this together, you can kind of form a mosaic. I could actually do an earnings analysis too, because earnings aren't like super deep here, but I think if I did, the earnings growth rate would be like super duper low anyway. You can just kind of glance and look, since like if you started this in 2016, the dark green area shaded our earnings. Now, if I notice that there's like a giant year, I really want to get what's the most consistent has been. And so if you look here and I haven't even looked to see if they, bought back stock or anything like that. So they may have done that. But if you look here, basically earnings growth is like nothing pretty much. I mean, it's very low. It'd be about the same as inflation if you went to the peak here. So even going from 2016 to the end of 2021, you're looking at 3% earnings growth, right? So basically there's not much, I wouldn't count on much earnings growth. Earnings growth was basically flat when you take into consideration inflation, right? So that leaves us with a couple different ways to kind of look at this if you're trying to do it quickly without spending, a month trying to disentangle like all the possibilities of a business this size. I will say I went and looked and I read their business descriptions, their segment descriptions in their annual report. And sometimes you read annual reports and they're just really bad, like they're badly written, they're hard to understand. I have no idea where this thing came from. But I liked theirs. Theirs was pretty clear. It seemed like it was written by people who are serious business people who are, trying to run a good business. So I did like that about it. And they did look like they announced some restructuring that they're going to try to do to cut costs and things like that. I didn't get too deep into it, but I like the way that it was laid out. It was easy to understand. If you go read it, maybe you can dig into that and try to figure out. Usually, if it takes that much time, then it's not something I think is usually worth doing. But maybe in this case, it's kind of a borderline one. It might be fun for a person to do. Okay, so I've talked about this from various different angles. We have compared to the dividend yield, which is actually quite high right now. It's nearly 10%. I've looked at it from the earnings, which it doesn't really look very good based on earnings because they're negative. I shrunk it down to before earnings fell off a cliff. So we know earnings are in a down cycle. They're not too useful right now. And to the degree that they are, they don't look good. Okay. But here's the thing that's interesting. If you go back to the Great Recession, what we're experiencing right now is very similar earnings-wise and stock price-wise to what happened back then. So one of the things that I like to do as a technique, and this is pretty easy on fast graphs, which makes it nice, is when you have a business that's kind of borderline, there's cyclicality there, but it's not like crazy deep. Like earnings never went negative during the Great Recession for these guys. So you can make those adjustments, and sometimes I do. But one of the things I like to check, and one of the techniques I like to do, instead of just simply going straight for my deep cyclical strategy, which focuses on it's just the stock price, is you can look at the peak cycle PE during the last recession, which we actually have here, which is nice, about 21.5. And then if you go pre-pandemic, okay, we'll go and look at the peak pre-cycle PE, which is exactly almost 21.5 in 2019. And then they went slightly more higher here during this little post-COVID boom, but it lasted it looks like a couple weeks or whatever. So, and that was during kind of crazy times. You can see earnings went down and came up, so the PE is a little tricky, but this is pre-pandemic, so we get a much better read. So you can see that the peak PE, because you don't have, it's just looking at this slice in time where earnings haven't dropped yet. The cyclicality doesn't matter because we're looking at two similar peaks. You can start to draw a little bit more similarities, right? So we can go back and say, well, they peaked out at a 21.5 PE when earnings were almost at a peak back in 20 2005, the beginning of 2005, or late 2004, let's see what the stock price did during the Great Recession. So we can do that by just tapping here and then tapping this. This isn't exact top to bottom, but it's usually pretty close. So stock price fell 66%. Okay, that's a pretty big drop. Earnings only fell maybe 45%, but the stock price probably really from tippy top to tippy bottom fell 70. So we can then go up here and compare this down cycle to that one, again, to get some estimates. So we're looking at the peak PE. We aren't looking at the PE down here because earnings are moving around a lot, right? So we go down to today's bottom, which it's at, and it's almost exactly the same. It's 66 below. So one way we can think about this is the stock is trading just like it's in a recession. So if you, like a Great Recession, basically. And if you look at what they do, it's like bed springs, parts for, cars, and then they have, they had a couple other big segments I'm trying to remember. Like home flooring and vinyl and things like that. So those are they all can be cyclical industries. And because of the boom during COVID, the sort of goods recession that we're in right now is a recession. Like the rest of the service economy isn't in a recession, but these guys produce goods, and those are in a goods recession. And probably because of the weakness in China and Europe, I mean, this is a big international producer of all these things, supplier of all these things. They are in like a goods recession, right? They are in a real recession. So even if the service economy picked up, if people aren't buying these things, and if you think about the housing market, this is actually a good thing to think about as well, because the housing market's holding up well, but the actual volume, the prices are in the U.S. at least, but the actual prices, volume of housing being exchanged is quite low, because interest rates went from being very low to very high. So people like me who have a low mortgage rate are not going to be selling their houses anytime soon. So the way to think about that is, if people are buying like new houses, if they're moving a lot, they're going to be buying a lot more of these types of products, right? Mattresses, furniture, building supplies and materials, maybe for home renovation. And then the other parts of their business, like the automotive part, now the interest rates have gotten high. The volume of autos are doing a similar thing, where really they're just unaffordable for most new cars are unaffordable. So the car companies are trying to make their money on margins and keeping the prices high. Well, that might help a car manufacturer, but the reduced volume doesn't help the companies that are the suppliers to the cars, because they aren't supplying as much stuff, right? Okay, so putting that all together, these guys are basically in like a Great Recession scenario, even though we actually aren't in a recession. So one has to think that things could get worse if we actually did have some type of recession, like in the U.S. But they're equally as bad right now. And it's not just the stock price that I showed you. Earnings are also down. Let's see what they're down. So these are projections here, but we're down almost exactly 50% right now from the boom peak. So we have all the elements of like a credit cycle downturn basically with these guys. Analysts expect earnings to keep falling this year. I'd put a giant question mark on that. I would not necessarily be so negative, because usually when you get 2 years like this in a row where earnings per share are just collapsing, analysts just extrapolate that out to the next year, and they'll keep doing that until these guys surprise and maybe put a bottom in, right? So I would put just a giant question mark. I don't think anybody knows. I think maybe these guys, if they're doing a restructuring and they're closing down plants and they're doing things like that, however long that takes, they'll probably find a way to kind of at least do better than expected Whether that happens this year or not, I don't know. So I wouldn't be quite so negative, but I basically would just put a question mark. Like I said, I don't think anybody knows what earnings are going to be. We do know that right now they're in a down cycle, which makes this interesting because if we have a similar pattern that happened back in the Great Recession, you would basically be buying the stock near the bottom here, and then if you held it up until earnings started to flatten out and things got a little sketchy, so maybe not the whole peak, but you get a 400% return in a decade or something like that. So there's opportunity there if that happens again. It took them a while, so it doesn't look like there's a rush. Back then we really were in like a full-on recession, global recession. We aren't there yet, so there's still risk to the downside, okay? So if we take all that into consideration, they do have some debt here, right? 50% long-term, and then you can tell that the enterprise value is now the stock price is very low, so this is going to there's going to be a big difference between the market cap and the enterprise value if they have much debt. Triple B minus credit rating, so they're right on the borderline basically on every single thing that you look at. Now let's look at the dividend. So I do have these guys in my dividend analysis. So they don't have any earnings growth, so I assume that the dividend doesn't grow at all here, okay? I must have calculated an earnings growth rate for these guys about 4%. So earlier I said I didn't have them in my other spreadsheet. Either I looked on just fast graphs and estimated it. This might have been before the decline or whatever, but that seems about right given what I just glanced at since 2016 or whatever, right? I showed I think on fast graphs it was like 3. So this is a little generous. It doesn't really come into factor because, actually this is the dividend growth rate. That's why. Let me move my head here. Yeah, okay, so their dividend growth rate has been 4%. So it's not like it's been gangbusters, compared to the earnings growth, which I showed was lately around 3%, growing just slightly faster than that. So that all seems like pretty good, but I assume that the dividend doesn't grow in this analysis, but the dividend rate is so high that even if it doesn't grow, if they just manage to maintain it, you can earn your money back, your initial amount investment back in 11 years from the dividend. So if you bought the stock for $100, you would get $100 in dividends after about 11 years. Usually 10 is what I want, like lower is better. But it's almost there. So this really comes down to, can they maintain this dividend for the next decade, right? And I think the market's being pretty efficient here. It looks like the risks are priced in. I mean, that's why it's cheap. I think, there's a couple different ways a person could play it. Part of me would say my favorite way, as not a primarily dividend investor, would be to wait for like a dividend cut, and then all these people that are holding it for the dividend will probably sell it and the stock price will dive. And I think that's probably like the best time to pounce on it. On the other hand, this seemed like a good business that's cutting costs. Maybe they can get this earnings per share up in the next couple years. The dividend doesn't get cut, and you can collect 9% or 10% for however long they, can keep doing that. That's not like a bad bet either. So, I mean, maybe a good strategy would be like, if you're like an income investor, to have a little flexibility, maybe take half a position right now and let that work as the potential that the dividend never gets cut, and then kind of withhold half in cash and collect 5% instead of 9%. And then if they do cut the dividend, actually come in and buy it as like a cyclical kind of recovery, because they look like they aren't like in danger of like actually going bankrupt or anything like that. We just don't know how long this next upcycle will happen, right? My inclination personally would be, it's a tough one. I think it's a 50-50 whether I really do. I mean, I probably wouldn't step in here and buy it for the dividend, but you're not just buying for the dividend. There could be a cyclical price recovery as well. I mean, So if you, let's see, I'm talking a lot on this one because it's so interesting. So back then the yield was about 6.5%. So, you know, you could get a 6.5% raised dividend for the next however many years when interest rates were like zero. I mean, it was a good bet back during the Great Recession. So there's definitely some upside there. But what I would say is, if you do come and take the risk in buying it, don't sell it too early if it works out. Because if these earnings come back, if they get back up to where they were before, even during 2018, you're looking at a $34 price, you're looking at a double. So that's kind of, you're at least probably going to get a double on the stock price. And then maybe, that 300 or 400% that we saw before. So it's pretty juicy looking. I haven't stepped in to buy this one yet, but I would be watching it. I think I would probably buy it if they cut the dividend, honestly. I mean, nobody wants to hear that because everybody's asking about this, probably because of the dividend. But for me, I mean, being a dividend king, having all these investors that want the dividend, that are buying it right now for the 9% dividend, or have been as the stock's been falling, to get that dividend cut, I mean, it might be a last resort for these guys. I'm sure they'll cut workers and cut all kinds of stuff and sell assets because they want to keep that dividend status because it attracts investors, which doesn't make any sense if I haven't looked at the compensation, but just generally, I mean, there's no reason other than maybe keeping activist investors, out of your business to really care what the stock price does for a business like this, other than like executive compensation. So, but they do. The fact of the matter is they do. So we'll just have to see what happens. I don't have a clear answer on this one, but hopefully I framed everything okay. So there's some different ways for people to think about it. And best of luck. Let me know what anyone decides to do with it, and we'll in the comments, and we'll see how it all turns out. All right, thanks for watching. This was an interesting one to think about. I thought about it for a couple days before I made this video. So if you have any other requests, just put them down in the comment section. If you found this useful, hit the subscribe button. I'll see everybody later.